Hi there. Today we are going to discuss accounting of equity. Equity is the section of the balance sheet, and by the date you do know that there are at least 2 lines or maybe 3 lines there. Share capital, which is the initial investment in business, retained profits, which is compiled out of the profits earned during the whole life of the business. And sometimes revaluation reserve could appear there. We've discussed that. But today we'll discuss that section in more details. When we speak about accounting, we speak mainly about basic accounting equation, which is assets, which always equal liabilities plus equity. When we talk about financing of business, we talk about 2 ways how we can do that. We can borrow money, that is going to be our liability, for example, bank loan, and equity, which is the cash or money of the shareholders, of the investors. Assets is what I own, if we speak about business. Liabilities is what I owe, my debt. And equity is what I am worth. So this is the section which shows the welfare of shareholders, the wealth of the business, the size of the business. And as I said before, equity is presented by the share capital, the initial investment, and retained earnings. Liabilities, normally they are borrowings, overdraft, short-term borrowing, loans, and different debentures, different bonds. These are loan stock, bonds and obligations and other stock which could be traded on different stock exchange, like New York Stock Exchange or Moscow Stock Exchange. When we speak about shareholders' equity, we define it as the residual claim on assets after settling claims on creditors. So assets less liabilities. Equity is assets less liabilities. Shareholders' equity due to share issuance could be defined as contributed capital, common stock, and preferred stock. We're going to discuss in more details today. And treasury stock. Treasury stock is the stock which was repurchased from the public and subsequently it could be reissued. If we speak about shareholders' equity due to operations, we speak about retained earnings. We've discussed it many, many times, and this is the beginning retained earnings. Then we can add net income for the year or deduct the loss for the year. And we have to decrease the retained earnings by the sum of dividends which were paid during the period. By the date, we were not discussed dividends, but today we are going to introduce that new definition into our accounting knowledge. And when we speak about something that bypasses the income statement but still increases the welfare of the business of the shareholders, we call it accumulated other comprehensive. Before at the previous lectures, we can revalue our assets up, so we can add some value to the assets because the market changed, because the economy changed, but it's not the income because it wasn't earned. So we definitely became richer, but it's not something which was earned by the business. So that like income won't be shown on the face of the income statement, but still appear in equity, showing the increase in richness, the size of the company. Let's discuss the graph, which is on the slide now. The maximum number of shares of stock a corporation may issue is called authorized stock. It is stipulated by the main document in the company. In Russian, we call it Ustav. And this is the number of shares which was defined at the beginning of the business, at the very start of the business. Issue stock has been issued by the corporation. And normally we can see the shares which are traded in different stock exchange. This is issued stock. Stock held by the stockholders is called outstanding stock. So the outstanding stock, these are shares which could be bought by you, by me, by different companies, funds, etc., etc. So this is outstanding stock. And on the graph, you see that the largest circle is the authorized stock, the maximum number of shares that company can issue. The orange circle, which is within blue one, this is authorized and issued stock that has been issued but may or may not be held by stockholders. So some of these shares could be repurchased from the public and held at Treasury. And the circle in the very center, in the middle, the red one, is the authorized, issued, and outstanding stock that is held by stockholders, by you, by me, by brokers, by funds, by different organizations, by different people. So these are three different types of stock the company can speak about, the company can define in its documents. And let's look at the equity sections of the statement of financial position of different companies. If we speak about the small company, about the sole trader, about the maybe one person who owns a business, we'll see in equity the capital which was brought forward at the start of the year. But if we look at the note 1 on the left side of the slide, if the company just started its operation, the owner will invest some money, capital, in the business, and will include that amount of money here. During the year, at the end of the year, we should add net profit earned for the year, and sometimes we have to deduct drawings. And note 2 states that drawings are cash or maybe goods taken out of the business by the owner for personal use or payments made by the businesses on behalf of the owner personally. So it's the assets which were taken from the business. It's not the businesses anymore. Drawings are not to be treated as an expense because it's not so. It's just the decreasing of the capital. And in order to calculate profit, we have to exclude drawings out of our expenses. It's like the appropriation of profit. So something which was left from the, which should be deducted out of profit. When we speak about partnership on the right side of slide, I can say that that the records here, the lines here are almost the same as in sole trader, but in partnership we have at least 2 partners, so maybe more. So it's not a company, it's not joint stock, but a partnership. And partnership is much like a sole trader, but we have to divide capital between different partners and then calculate total of capital. And we have to account for drawings in respect of each partner separately. And when we speak about company, the large company and normal company, the companies you can see around, we talk about issued share capital, ordinary shares. We introduced today a new definition, new line, which is called share premium, the premium which was received by the company above the nominal value of the share. We can see revelation reserve in equity section, as I said before, and retained profits here presented by the profits or earnings accumulated into the business for further development. And the sum of all these lines would be total equity of the company. So let's discuss it in more details. Today we start to study, we have to learn how to compile statement of changes in equity. This is the 4th reporting form. As far as you know, there are 5 main financial statements. The first one is balance sheet or statement of financial position. The second is income statement. We can call it profit and loss statement also. The third is cash flow statement, and this is the topic of the next week. And the 4th is statement of changes in equity, how equity changed from the beginning of the year till the end. And the statement number 5 is called notes to financial statement or disclosure. And this is the large book. And the larger the company is, the larger that disclosure would be, explaining each and every line of all these 4 statements. In statement of changes in equity, you can see as the heading of the table, share capital, share premium, revelation reserve, general reserve, and retained earnings, and they change throughout the year. So the first line here is opening balance. During the year, something happens. profit was earned, rights issued, bonus shares issued, some revelation of fixed asset happened, and revelation reserve increased. Maybe company paid dividends during the year. All these matters should be accounted for in that separate special financial statement. And the final line here is the closing balance. And on the very right side of the slide, at the lower right corner, you can see the total equity at the end of the year. At the upper right angle, you can see total equity at the beginning of the year. And below, you can see the total equity at the end of the year. And these are differences. These are deductions or additions happen during the year. Today, we are to discuss what happens and how to record that in order to compile that statement. So how should we account for issuance of stock? Normally, companies, large companies, raise capital by issuing stock. I suppose you have to know that. And the company can sell its stock directly to the stockholders, to me, to you, or it can use the services of an underwriter. Normally in the real world nowadays, the company uses different underwriters, different brokers, which help them to issue and distribute stock between potential stockholders, shareholders. Stock of public companies are bought and sold on a stock exchange, such as the New York Stock Exchange, NASDAQ, London Stock Exchange, Moscow, St. Petersburg Stock Exchange. In Russian, we call it birja. The issue price is the amount a corporation receives from issuing stock. So each share has a price. And today we are going to discuss two different prices for each share. There is nominal value and the issue price. And sometimes these are different prices. Nominal value or par value is the price which is stipulated on the face of the share. And if the company is popular enough and the expectation of the public is high enough, the issue price could be much higher than nominal value. But before we start discussing the accounting of share issue, we have to discuss shareholders' rights. A stockholder has 4 basic rights. Vote. Each share of basic ownership in the corporation carries 1 vote. So the more shares you have, the stronger your vote is. Dividends. Stockholders receive a proportionate part of any dividend declared and paid. And as you can see from the etymology of the word dividends, this is the division of profit. So if company earns profit, the portion of the profit or the profit in total amount could be split between shareholders, divided between shareholders. That is why we call it dividends. It's not an expense also. It's the division, appropriation of profit. When we speak about liquidation of the company, stakeholders receive their proportionate share of any assets remaining after liquidation. That is why we call share, because you can claim the share of the business. And preemptive right. Stakeholders have a right to maintain their proportional ownership. So in order to mitigate the possible dilution of shares, размытие доли, when the company issues additional stock, first of all, it allows the existing shareholders to purchase it in order not to dilute, in order not to increase or decrease their share in the company. So these are shareholders' rights. But since we are studying accounting, shareholders' rights is not the main topic of today's lecture. And if you are if you want to study more about shareholders' rights, about dilution of shares, about additional issues, IPO, you'd better read books. Maybe not our study guides, but study books for accounting, of course. And I suggest you to read some resources like Investopedia or something like that to study more about shareholders' rights issue and everything that goes with it. If the value of the company's shares, as I said before, in the marketplace is high enough, it may issue new shares at a premium. And the share premium is the difference between the price that the shareholders pay for the new shares and the nominal value or par value of those shares. So when we speak about share premium, this is the difference between the nominal value, which is written on the face of the share, and the market price of the share, the price the potential shareholder ready to pay for that. His or her expectation is high enough. The company receives the full amount of the cash and increases its share capital account by the nominal value of the new shares issued and increases its share premium account by the premium. So the company receives the total cash. Assets increase by the cash received from additional share issue. But since we are allowed, in accordance with accounting rules, to account in share capital shares at a nominal value only, the difference, which is above the nominal value of the shares issued, should be recorded on the separate account, share premium. So let's consider an example, share issue. The company issues 10,000 shares of $0.1. So this is par value, 10 cents, and sells them for 15 cents. So we can see the company sells shares with premium. How should we account that transaction for? We have to debit cash by 10,000 multiplied by 15. Of course, this is $1,500. So assets increase by $1,500. We have to credit share capital at par value of shares. So we have to credit share capital by $1,000 only. And we have to credit also additional account, which goes to equity section also, share premium, by the difference between nominal value and cash received by $500 in our case. So that would be the record. So if we look at the balance sheet, here you can see the extract from a balance sheet. In current assets, we can see increase of $1,500 in dollars. And in share capital, we're gonna find increase in share capital of 1,000 and share premium of 500. Rights issue. To attract new capital without affecting shareholdings, preventing the dilution of existing shareholders' voting rights, easier and quicker than ordinary share issue. What does that mean? When in need of money, can issue rights, right to buy a share. And when a company issues right to buy a share, as I said before, previously, before all other possible potential shareholders, the company suggests to execute these rights to the existing shareholders. And of course, all of them would agree, would find some resources to execute their rights in order not to dilute, not to decrease its share. And what we are interested in is the correct recording, correct accounting for that rights issue. So if we consider an example, we can see almost the same company with the share capital and reserves of 3 lines. Ordinary shares or share capital fully paid of $1,000, share premium of $500, and retained earnings of $2,000. This is the balance sheet equity section before a rights issue. Then company makes a 3-for-2 rights issue. What does that mean? The company allows existing shareholders to buy 3 new shares for each 2 they possess now. How many shares the company would issue? Let's calculate that. How many shares company has now? 10,000, because the company has share capital of 1,000 consisting of shares with a nominal value of 10 cents. That means that the company has 10,000 shares. So in order to execute that issue, the company issues 15 rights, 3-for-2 existing 15 rights at a price of, let's say, 30 cents, because the company is popular enough with the perfect perspective on the market, and the right to buy a share is 30 cents instead of nominal value, which is much lower. What would be interest and how share cap or how equity section would change after that transaction? Let's consider accounting entry first. We have to debit cash on the full amount received after the rights issue. Of course, we assume that all the rights were executed because no one wants to dilute its share. So we have to debit cash by 4,500. This is 15,000 rights multiplied by 30 cents. We have to credit ordinary share capital at par, nominal value, because we are allowed to increase or decrease share capital by nominal value only. And we have to increase share premium account by the difference between cash received, the issuance price, the price of issue, and nominal value of shares. In our case, this is 3,000. That would be an entry. And if we look at the balance sheet after the rights issue, we can find there increase in assets, cash increased by 4,500, and increase in share capital and reserves. Our share capital would increase by $1,500 and share premium would increase by $3,500. We have to add there $3,000 of premium received at the rights issue. And of course, after that transaction recorded, our balance would still be in balance. So this is the case with the rights issue. The rights issue is the way of financing business. So if the company needs money, it can issue rights, and shareholders would pay cash for that right to buy a share. So this is the source of finance the business. Bonus issue, it's not the source of finance business, but this is the operation which could help company to decrease the number of lines, to decrease the number of reserves in equity section. Companies use bonus issues when they have built up reserves in the statement of financial position that will not otherwise be distributed to owners somehow. The valuation reserve, share premium, and some other general reserves. So as we discussed, companies can revalue fixed asset and increase the valuation reserve, but that comprehensive income, which is not income and will never appear in income statement, couldn't be distributed as dividends between shareholders. But with the help of bonus issue, we can do so. We can do so by increasing the number of shares and distributing them between shareholders. So bonus shares are apportioned proportional to the existing shareholders, and the number of issued shares increases while there are no real effect, no cash flows. So the market price of shares tends to fall proportionally. That is the second purpose of bonus issue. If the price of the share is very high, for example, as the share price of Google, which is much higher than $1,000, and it's almost impossible for the ordinary human being to buy that. So the company can execute bonus issue in order to increase the number of shares and decrease the market price of the share, because the number of shares increases and the market price of the company stays the same. No cash associated with that transaction. Okay, so let's consider bonus issue. As I said before, purpose of a bonus issue could be to increase share capital without issuing new shares for cash. So if we want to increase share capital, not the equity, but the share capital. To increase liquidity of shares, as I said before, we can increase the number of shares, and eventually, as the result of the bonus issue, the price of the share, the market price of the share would decrease. To simplify balance sheet, because sometimes we can have a lot of lines, a lot of different accounts in the equity section, and if we perform bonus issue, you'll see it later, we can simplify balance sheet, simplify equity section. And we can to freeze some reserves in share capital with the help of bonus issue. And of course, the main purpose, which is highly valued by shareholders, is the ability to get their undistributed profits as bonus shares, as revelation reserve or share premium, for example. So they won't receive any dividends, but they would receive additional shares. So to sum up, in bonus issue, no cash changes hands. So companies do not use these issues to raise finance. A beneficial effect of a bonus issue that lowers the market value of a share, and is that investors may find it easier to buy and sell shares if they are cheaper, since sometimes shareholders are loath to buy shares with a high unit price. So it's impossible for me, for example, to buy Google share. Investors may regard holding the shares less risky in this situation, which again may help maintain the total market capitalization, namely total market value of the company. So companies might use bonus issues when they have built up reserves in their statement of financial position that will not otherwise be distributed to owners, and to increase the liquidity of shares. So let's consider entries and effect on balance sheet equity section. So if we have to increase share capital and decrease other reserves, we have to start bonus issue, recording bonus issue, with the share premium. That sequence is stipulated by the standard. So we have to create a share capital with the par value of the shares issued, and we do not speak of any difference between issue price and nominal value, because of course bonus issue is performed at a par value. So we have to create a share capital, and we have to debit share premium account. And of course the share premium account cannot be negative, so we have to stop when the share premium is fully utilized. Then we have to continue with the revelation reserve. If the share premium account has a zero balance, the revelation reserve account cannot become negative also. If revelation reserve ends, we have to go to retained profits if necessary. And this sequence, as I said before, is stipulated by the standard. And of course, as in each and every accounting entry, we have total debits equal to total credits. In our case, only one credit here. And it's going to happen that there would be several debits decreasing in different equity lines. So let's consider an example. Before a bonus issue, equity section looks like that. Share capital fully paid of 25,000 shares with a nominal value of 10 cents. Share premium $3,500 and retained earnings of 2,000. The company makes a 4-4-5 bonus issue, 4-5. So the company has to issue 25 bonus shares. Why? Because now company has 25,000 shares. If we multiply nominal value by the, not multiply by divide, if we divide the total share capital by the nominal value, we can have the 25,000 shares as the share capital existing. 4 for 5 existing, 4 new for 5 existing means 25. So 25,000 divided by 5 multiplied by 4, 20,000 bonus shares. And let's consider now the share capital and the other reserves after the bonus issue. An entry would be debit share premium, decreasing the share premium by $2,000, because 20,000 shares with a par value of 10 cents gives us $2,000 of increase or decrease in different reserves. We have to debit share premium. We start with share premium, and we have to credit increase ordinary share capital at par. And the equity section now looks like $4,500 as a share capital, decreased share premium account $1,500, and no change in retained earnings. The total is the same. The total is the same here. No additional cash no change in accounting equation. And now let's consider an example with the use of statement, with the compilation of statement of changes in equity. So let's assume that there is a company with different lines in equity section. So the company has share capital of 10,000 shares with a nominal value of 10 cents each. So the share capital opening balance at the beginning of the period is $1,000. The company has share premium account, which was brought forward $500. No revaluation reserve and no general reserve in the company, and the company has retained earnings account equals $2,000. So the total equity, the total capital of the company at the beginning of the year was $3,500. During the year, company earned profit. So let's assume that profit was $700. That profit would increase a retained earnings account for sure. So we have to add in the column the retained earnings 700, and of course total equity would increase as well. So the total capital increases. Let's assume that the company performed rights issue during the year. Shares rights for cash. So the cash increased and share capital increased also. But since we see here the nominal value or par value of the share equals 10 cents, and rights were issued at 30 cents each, we can assume that share premium would increase. Let's calculate the number of shares first. Currently, the company has 10,000 shares outstanding. 1,000 divided by the nominal value, 10,000 shares. So for each existing 2 shares, the company issues 3 new. So the company issues 15 new shares with a nominal value of 10 cents, but receives 30 cents for each issued shares. So share capital would increase by 1,500. This is 15,000 shares at par value. But since the company totally received $4,500, the difference between nominal value and the issue price should be accounted for at share premium account. So an entry was debit cash, $4,500, credit share capital, $1,500, credit share premium, $3,000. And of course, that entry would increase total capital because we add cash to the business. So assets increase and equity increases. Then let's assume after that rights issue, the company performed bonus issue. The company issued 4 new shares for each 5 existing. And now company has 25,000 shares. 25,000 shares. 10,000 was at the beginning, and 15,000 was issued additionally. So company now issues as a bonus issue additionally 20,000 shares with a nominal value of $0.1. We have to increase share capital by the number of shares multiplied by nominal value, $2,000. But since bonus issue is non-cash operation, it's not no cash associated with the transaction, we have to utilize other reserves. And we have to start with share premium in accordance with sequence prescribed by accounting standards. So we have to decrease share premium by 2,000. And we have enough resource in share premium, so we can use only share premium, decreasing it by 2,000. And eventually, no effect on total equity would be recorded. So we increased share capital and increased share premium, decreased share premium. Now let's assume that some other transactions should appear here. Let's assume transfer to reserve, general reserve of 250, and revaluation of land by 1,200, by 1,200. So when we speak about general reserve, some companies like banks, insurance companies, and some others, they are obliged to have an increased general reserve in order to be able to respond on any claim from the public. So what you should know, you have just to know the technique of transferring the money, the reserves to general reserve. So we have to decrease retained earnings because general reserve is compiled out of profit. So we have to use profit earned for the period in order to increase or form general reserve. So we have to decrease retained earnings and increase general reserve. And this is the reserve which should be held at the company, and distributable reserve, because as far as you know, retained earnings could be distributed between shareholders as dividends. And amount transferred to general reserve helps us and companies to save money for special needs, for claims, for responding to claims of the clients, contributors, and public. No effect on total, of course, because we decrease one reserve in equity section and increase the other. And if we assume revelation of fixed asset, we would increase the asset value, and we would increase revelation reserve by the same amount. And of course, that transaction would affect on the total equity. The total equity would increase by the same amount because the accounting equation would be affected, increase in assets and the same increase in equity. And as you can see, that transaction, revelation of fixed asset, revelation of land, it affects the wealth of the company, the wealth of the shareholders. And since the equity is the claim of the shareholders, the worthiness of shareholders' shares, we show it here. So if the land which is in possession of the company increased in value, we have to state it, to show that on the face of the balance sheet. And if company pays dividends during the period, we have to decrease retained earnings in the equity section. Dividends are paid in cash. That is why accounting equation would be affected again. So we pay cash, we decrease assets, and we have to decrease the retained earnings. Let's assume that the total amount of retained, or the total amount of dividends paid during the period was $350. We have to decrease retained earnings, and of course, total equity would decrease also because we distribute cash between shareholders, so the assets decreases and equity decreases. And that would be the last operation concerning equity in the company during the year. So the final line, which would appear on the screen right now, would be the closing balance of equity and each and every line, each and every reserve within equity. So share capital would be 1,000 plus increased by 1,500 due to rights issue and 2,000 due to bonus issue. The closing balance for share capital would be 4,500. As for share premium, it increased by 3,000 but decreased subsequently by 2,000 due to bonus issue. That is why the total share premium at the end would be 1,500. Revelation reserve appeared to be 1,200. General reserve 200.5, and retained earnings increased by the profit earned during the period, but decreased because of transfer to general reserve and dividends paid. So the final closing balance would be 2,500. The total equity, the total final capital would be 8,550. That would be the closing capital in the company. And we can see that from the beginning of the year, it increased more than by $5,000, and the company became richer, the wealth of the company, the wealth of the shareholders increased. That is the statement of changes in equity showing the change in different reserves during the financial period. And now we have to talk a little bit about different types of stock. We have two different types of stock. Common stock, which is at the bottom of the slide. This is ordinary shares. You like owning the share of the company. It is riskier, of course, you may lose it all, but often provides a better chance to participate in the growth of a successful company. So if you buy shares on the stock exchange with the help of brokers nowadays, you normally buy common stock, not the preferred stock. Preferred stock is more like a debt, so we call it quasi-debt. This is something between debt and stock, between debt and shares. in the company. And when we discuss preference shares, we normally use the word like debt and interest. That stock allows no voting rights. So it's not like the common stock. If you possess with a high percentage of common stock of the company, you have the right to vote to define the future of the company somehow. But if you own preferred stock, you have no voting rights. But it allows you to receive a fixed dividend that must be paid before ordinary dividends. So dividends on preference shares are considered to be much like an interest expense and shown in the income statement as an expense alongside with any real interest on loans. So it's not the division of profit, it's like an expense, and we must show it on the face of income statement. And by the way, dividends on ordinary shares are an appropriation of profit and are not an expense. It's the division of the final net profit. Such dividends, as we discussed, they are only accounted for when they are paid, and hence any proposed, promised, discussed, expected dividends is not accrued. So we do not make any accrual for proposed dividends. We show paid dividends as a deduction from retained profits in the statement of movements in equity, as we just did, only in the moment of payment. But preference dividends should be counted for as interest expense, and we accumulate accrued preference dividends on the face of the balance sheet as a liability. This is the main difference. So any preference dividend not paid in 1 year will be carried forward as a liability to be paid in the following year. And any unpaid preference dividends must be accrued, much like accrued interest expense, electricity, wages, or something like that. So this is the main difference between preferred stock and ordinary stock. So we show preferred stock as a liability, preferred stock as a long-term liability, not as equity, and preferred dividends as an interest expense. Common stock always shown in the equity section. Dividends. Profitable corporation may make distribution of profits, as we've just discussed, and you'd understand from the real life and from other subjects, I hope. So this is the distribution of profit between shareholders in the form of dividends. And dividends can be paid from cash or other type of property. Sometimes dividends are paid in stock, in shares, I mean, not in stock as inventory held for subsequent sale, but it could happen also, but as additional shares. So it could happen. Legal capital refers to the proportion of stockholders' equity that cannot be used for dividends. So there are some reserves which couldn't be distributed. For example, general reserve, which is held for other claims of other clients, other public. How much ordinary dividends company is allowed to pay? Legality, we have to consider legality, retained earnings. We have to consider liquidity, cash availability. So if company has no cash, it's possible, but very difficult to pay dividends. The company has to consider investment opportunities. Maybe it's better to reinvest profit in the business. For example, Google never pays dividends because company reinvests profit earned back to the business in order to improve the business, in order to expand the business of the company. So Google never pays dividends. The company has to consider dividend policy, consistency. So if the company normally pays like 10% of profit as dividends, company, of course, shareholders expect from the company to pay that percentage of profit as dividends subsequently. And it would be the bad signal if the company decreases the amount or percentage of the profit paid as dividends. And of course, the amount of dividends paid could be like a signal to the public. If the company pays high dividends, it may be a signal that company like feels well, and that would attract new shareholders. Or if company decreases or doesn't pay any dividends this year, that could be a signal that company has some financial difficulties and difficulties within business. Ordinary dividends, as we said before, it's not an expense, and proposed dividends shouldn't be accrued on the face of the balance sheet. And ordinary dividends are shown as deduction from retained profits and the statement of movements in equity only when paid. So we've discussed it already. It's just the slide repeating that information. Preference dividends. Dividends on preference shares, on the other hand, are considered to be much like an interest expense and shown in the income statement as an expense alongside with real interest and loans on the balance sheet. So how should we account that for? We have to account for payment of preferred dividends as expense and profit and loss statement. We have to debit preference dividends and we have to credit cash. If dividends were not paid in current period, we have to accrue liability in balance sheet, dividends payable. And then if the company pays dividends, we have to decrease that liability or to set it to zero, decreasing the cash. That would be normal accounting entries, nothing special, just highlighting the situation with the preference dividends. No entries associated with the ordinary dividends like that, I mean. We have to record only payment of dividends. So we would record debit retained earnings, decreasing the retained earnings when we pay ordinary dividends, credit cash. Stock dividends have the following characteristics. They affect only stockholders' equity accounts. They have no effect on total stockholders' equity, never. They have no effect on assets or liabilities. No effect on assets or liabilities. And dividends in shares rather than cash should be accounted like that. Debit dividends, credit share capital and share premium if we issue additional shares for dividend purposes at premium. But what can I say? I'm teaching principles of accounting for almost 10 years now. I'm in that subject of University of London. And I've never seen such kind of question in the final exam. So we just include that slide in the lecture because study guide like describes that situation, but thanks God, never such type of question appeared in the exam hall. Split of shares, the final step for today, and we'll finish. Split of shares is just the change in the par value of shares, no effect on financial statements. So we just like divide each and every share into several parts. So we'll like split them. No effect on assets, liability, or equity of the company. So if company performs 1-for-2 stock split, means twice as many shares of the par value cut by 2. The market price of shares falls by half. And the purpose of share split is the increased liquidity of shares. So let's consider again the example with Google. If Google performs split of shares, the liquidity of shares would increase, though total assets, total liabilities, total equity of the company stays the same. So only each share would be split in 2, 3, 5, or 10 parts. Stock split is fundamentally different from a stock dividend. So we do not consider any stock dividend or bonus issue now. It's just the increase the number of shares issued. That's all. So stock split decreases the par value and eventually the market value per share, whereas stock dividends do not affect par value per share, never. Okay, so this is the concepts you have to know, considering accounting for equity, different kind of stock, preferred and ordinary stock, different kind of dividends, and of course, you have to be ready to compile statement of changes in equity at the final exam. And the final slide for today is the effect on bonus or balance sheet equation of different share issue. So when we speak about rights issue, the form of investing in business. We're going to see increase in assets because the company receives cash, and increase in equity because the company increases number of shares. When we discuss bonus issue, our accounting ratio won't be affected because equity increase, not equity, but share capital increases within equity section, but in the same moment, we observe decrease in share premium and maybe regulation reserve and retained earnings also. And when we speak about split of shares, no effect on balance sheet equation. We do not deal with any cash, money, or financials. We just split shares in 2, 3, or several portions. That is all. I wish you good luck with your studies and with your reading of, by the way, chapter 7 of study guide. Very comprehensive and very straightforward chapter with the nice examples in it. I suggest you to read it for self-study. Thank you so much. Goodbye.